Well, good morning and welcome to the Solaris Long-Short Webinar on what are the best long-short investments following reporting season. My name's Mark Cormack and I'm a Director with Pinnacle Investment. Pinnacle works alongside Solaris to distribute their investment management capabilities to the Australian financial advisory marketplace. We've just come through the August reporting season and it's thrown up some interesting company results and outlooks. So to guide you through our analysis of reporting season, I'm joined by Damien Coyne and Gus Roberts from the Solaris Long-Short Investment team. In terms of background, the Solaris Fund Management Boutique has a 17-year track record of investing money in Australian equity portfolios. And currently the team manages $7 billion in funds for both retail, institutional and wholesale investors. Solaris adopt a style-neutral approach to investing, meaning they're neither growth nor value, and their approach has enabled the team to outperform in 15 out of the 17 years of their track record, which is a track record that most fund managers envy. Like all our boutiques within the Pinnacle suite, the Solaris investment team own the majority of equity within their fund management business. But equally important, the Solaris team have had a very stable investment team and have been working together for well over a decade. In terms of performance, I'm actually delighted to say that the team's outstanding investment track record has continued, with the Solaris Long-Short Fund delivering well over 10% outperformance over the ASX 200 since inception. The fund is also highly recommended with the likes of Zenith, which is a great endorsement and recognition of the team's consistent investment approach in delivering outperformance over the Australian equity market. So before we start, just a couple of quick housekeeping items. A reminder that all attendees have the opportunity to ask questions via the questions tab on your screen. So without further ado, I'll hand you over to the Solaris Long-Short investment team of Damien Coyne and Gus Roberts for today's presentation. Thanks guys.
Great, thank you Mark. I might just start with a bit more detail about Solaris. So we are a style-neutral manager who picks stocks using bottom-up fundamental analysis to help exploit market inefficiencies in forecasts and valuations. So style-neutral means that growth, value and many other factors can be the source of investment returns. That's both on the long and the short side. We are an experienced team who have been investing together now for well over a decade. And we have 7 empowered analysts who are the experts for the stocks within the allocated sectors. So this is where we are a little bit different to our peers. So we think the analyst, rather than a portfolio manager, is best placed to weigh up an investment as they're the most familiar with the stock.
Now if we move over to the next slide. Now this chart really highlights the objective of our long-short fund quite well. It is an extension fund. It's a 130-30 long extension fund. So it leverages off our flagship long-only core product. It utilises all of this IP and the same investment team, the same investment process to come up with its decisions. As that previous slide detailed, our core fund has had a long history of consistently delivering alpha year in, year out. With the launch of our long-short fund, we are able to amplify these returns through shorting and monetising our negative views. This also provides the low-risk capital which we are able to reinvest into our high-conviction long ideas to further add alpha to investors.
Okay, so let's take a quick look at August reporting season. And it really was quite a tumultuous period to say the least. So despite the distraction of politics both here and abroad, it was the earnings results which dominated and really drove some exceptional volatility. So the ASX 200 looks set to finish the month in the green, and I suppose this really is considered quite a resilient performance, especially in light of the expensive starting valuations of some sectors, and that overall I suppose it really was quite a lacklustre reporting season, particularly in terms of the outlook. So on our estimates, only 17% of companies beat financial year 19 earnings expectations, whereas 40% actually missed and 44% reported numbers that were just in line.
Now if we look at that bottom right-hand chart, interestingly the metal and mining sector is no longer providing the earnings tailwind as has been the case over the last few years. Despite this, there appears to be signs of a recovery in maybe some of those more later cycle sectors, such as steel, energy, mining services and chemicals. On the flip side, many defensive sectors actually disappointed through reporting season and didn't provide the safe haven investments they ought to be. Containers and packaging, utilities, telcos, food and bev, transport, healthcare and food and staples all disappointed. Some of the other themes is that higher energy prices and input costs are starting to bite many companies, and also some of the higher quality offshore earners generally performed better than the domestically focused companies.
The other focus of this reporting season was the performance of the high PE names, which continued to re-rate despite many of them providing softer guidance or announcing increased spending, and we'll cover off on this a little bit more later. So in summary, the earnings growth for the broader market remains decent, I suppose, without being stellar. So the industrials ex-banks forecasts to deliver around 8% earnings per share growth in 19. And I suppose while we think some segments of the market are now looking expensive, we also still believe there are some opportunities out there.
Now, one of our best long ideas leading into reporting season was Altium. Some listeners might be familiar with this story. We've sort of talked about it before, but for any new listeners, Altium is an electronics software producer. They specialise in printed circuit boards. Pretty simply, it is a huge market that is growing really rapidly. As highlighted on this slide, Altium are pretty much running rings around their competitors. Altium witnessed substantial license growth in financial year 18 versus pretty negligible growth at their competitors. Their subscription pool is the largest and fastest growing in the industry, leading to revenue growth that is circa 2 to 3 times the average in the industry. So not only are they getting exceptional revenue growth, but they're also getting margin expansion. So they're seeing some exceptional growth in profits on the bottom line.
Looking forward, I suppose the proliferation of electronics through the rise of smart connected devices. So think of the Internet of Things, for example. We think this rise will continue to drive growth for this business. Management reconfirmed their commitment to achieving their 2020 aspirational targets of 200 million in revenue and 35% EBITDA margins. And this reconfirmation resulted in upgrades across the street for both financial year 19 and financial year 20 as the sell side play catch up. So we think they will get there organically, and there's probably some further upside if you factor in any contributions from future acquisitions.
And one of the key takeaways from this result is that management are now focused on becoming the dominant player in the industry rather than just a market leader. So management have now committed to hit 100,000 subscribers by 2025. They're only at circa 37,000 subscribers, so that sort of indicates substantial growth to hit those numbers, and that is to become the dominant player in the industry.
Now, just for full disclosure, post the strong share price reaction to the result and post the recent re-rating, we have actually taken some profits in Altium. However, fundamentally, we continue to like this story due to their strong balance sheet, which is net cash, their exceptional operating momentum, the earnings upgrades we're talking about, and its really supportive industry dynamics. It's just getting a little bit harder to stay ahead of the valuation at the moment. So given certain segments of the market are starting to look expensive, it should be no surprise that we're also finding plenty of opportunities from the short side, which can provide a great hedge or great downside protection in these expensive markets.
So Damien, maybe it's a good idea just to run through our shorting philosophy very quickly.
Okay, so our approach to shorting is fairly unique in that our main objective is to compile a very low risk and diversified short portfolio. So at Solaris, once a short is identified, it's first grouped into one of 3 categories, namely the outright shorts, the funding shorts, or the paired trades. And now we categorise these shorts for 2 key reasons. So the first one being it broadens the alpha stream, so it opens up a much larger shorting universe. And then secondly, the key reason, it helps us to manage risk. So it helps us to avoid concentration risk or short squeeze risk. So today we're going to focus on just the outright shorts.
So outright shorts, these are your more traditional event style shorts, stocks that are expected to outright fall in price. They likely fail our initial financial, geopolitical, ESG or litigation screens. They have earnings risk or may simply just be overvalued. They typically are shorter shelf life, higher turnover trades. These are more of your catalyst driven shorts, and reporting season can and was a really big event for these trades. We've actually had a pretty successful month trading some of these outright shorts. This was largely driven from our analysis that some stocks were overvalued despite having earnings risk, particularly some of the growth names and the tech space. This chart really just highlights how expensive growth has gotten relative to value. Levels not seen since the dot-com bubble, which look extremely stretched to us and extremely expensive. And it's obvious that some of these names were just simply not priced for an earnings disappointment. Stocks like Cochlear, Invocare and Ansell, they all had strong runs leading into reporting season and then failed to deliver on earnings expectations. In all of these cases, the disappointment was priced in almost instantly, hence the shorter shelf life.
So whilst there's always a place for the outright shorts in our process, we would caution that they are riskier propositions and can become very prone to short squeeze risk, which is also very evident and was a major feature throughout the August reporting season. So there is a whole plethora of other expensive growth techie stocks that quite simply we're just not brave enough yet to bet against, simply because they've all been caught up in this momentum vacuum. So for example, there were several names that were already heavily shorted going into their results, and despite reporting softer numbers, saw the share prices squeeze and they rallied a further 10% as the shorts covered, which left many investors just simply scratching their heads.
Yeah, and given this sort of scenario, Damien, you can sort of imagine how difficult it can be trying to manage a short portfolio that is purely focused on the popular outright shorts. As we've discussed in previous webinars, we effectively manage this risk by diversifying into the other more pedestrian style categories, such as the funding and the pairs trades. Here, the hurdle for success here is much lower in these names. They are lower risk, and we can take longer term multi-year views on these trades. So we go to the next slide, and to run you through this slide, we have our analyst Charles Story here. He's going to provide a pretty comprehensive overview on financials and resources. Where to from here? Over to you, Charles.
Yeah, so obviously the banks have been quite topical with the Royal Commission that's been going on this year, and one of the repercussions we've seen from the Royal Commission is the banks' inability to reprice their mortgages. Their what we call net interest margin has been under quite a lot of pressure, mainly from higher funding costs. And in the past, the banks have been very successful and had quite strong industry structure in being able to raise their mortgage rates to pass on these costs to consumers. But with the sort of political pressure and that Royal Commission looming in the background, that's been much more difficult. And we saw Westpac move rates this week, which was actually quite a surprise to the market. And we're not sure whether the other banks will be able to follow. We think they will be able to in time, but it is becoming much more difficult. The other thing in terms of the outlook for the banks, which we're thinking about at the moment, with the developments in Canberra over the last couple of weeks, is what a potential change in government could mean for the sector. So if we look at just some of the policies that Labor's announced, changes to negative gearing, changes to franking credits, we also think they could make the Royal Commission powers more wide-ranging. So far the Royal Commission's mainly, as we know, been focusing on conduct. They could change those terms of reference to include other areas such as competition within the industry. And the bank levy, which was introduced by the coalition government, is currently at 6 basis points for the banks. That also could potentially be increased if Labor get in. So, you know, we're cautious as a sector. We realise that they do have some valuation and yield support at the moment, and they're trading at quite a big discount compared to their normal discount to the market. However, we do think that the earnings pressure still remains there. And if we also have a look at resources, so what we saw during reporting season is the excitement, and we've seen this over the last couple of months. The excitement of the resources sector has come down a little. So one of the big themes of reporting season for the resource stocks was they're getting quite a bit of cost pressure and cost inflation at the moment, and that's twofold. That's in their raw materials and it's also in their labour costs. Quite a few banks are reporting, quite a few resources are reporting up to 10 to 15% cost inflation, and that's something that they haven't experienced for quite a while, and the market's probably underappreciated that a lot, and the oil price increasing hasn't helped that either. So sort of the large EPS upgrades that we saw in the sector a year ago are no longer there. You've also got quite a few geopolitical issues there at the moment with the Trump tariffs and also China economy slowing a little bit. So the sector is no longer as a real big driver of the market as it was, but we're still cautiously optimistic. The balance sheets are in much better condition than they were sort of 2 years ago, and the capital allocation has dramatically improved from what we saw during the last cycle. So the resources sector is still looking okay, but it's not as attractive as it was.
And Charles, thanks for the update. What about your top pick for the banks and resources?
Yeah, in banks, we actually quite like Clydesdale Bank. It was spun out by NAB a few years ago now. They've recently done a deal with Virgin Bank in the UK, and we think that provides a lot of optionality and a lot of upside in terms of revenue and earnings to that business, and it's obviously not exposed to the pressures that we spoke about in the domestic environment. So relative to the Aussie banks, we think that looks okay. And in resources, we still really like BHP. We think their capital allocation will be much better in the future than it has been in the past. The balance sheet is very lowly geared, especially with the announcement of their US shale assets. And they're doing quite a good job on productivity to try and offset that cost inflation we spoke about earlier. So valuation-wise, we think that looks quite good in the sector.
Thank you, Charles. So then just finally onto the market outlook. If you look at the chart on the left-hand side there, the performance of the accumulation index, you can see it's been almost a decade now since the GFC. And just looking at this chart alone, it's probably a fair statement to say that we're closer to the end of this bull market than the start. But as we all know, bull markets don't simply roll over and die from old age. They tend to die from hubris and excesses. So paying over 30 times today really isn't uncommon for some growth stocks. I know a handful of names in the ASX 200 today are trading at near or above 100 times PE. So valuations that were formerly seen as ridiculous suddenly become justifiable as we all get lured into this momentum trade. Pockets of small caps are also looking expensive, again particularly in that tech space. Some of these sparkly and glamorous stocks are trading on nosebleed valuations. We have not only reduced weightings to these segments, but have just started to target some of these names from the short side. So how do you attack a market at the more mature stage of the bull market? Well, we think this is a great quote from Peter Lynch, the author of the investment classic One Up on Wall Street, when he said, "Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves." So we think it's a real trap trying to position yourself for a major market correction, and it's something that we would never advocate. Good companies that are reasonable value with good growth prospects and solid balance sheets still exist and will always endure regardless of market conditions. And this is one of the real advantages of a 130-30 fund. So you're able to retain market exposure from your quality long portfolio, but you also have the ability to hedge the downside risk by shorting stocks that you think should underperform regardless of market direction.
So look, that's largely it from us and is a really quick summary of how we saw reporting season and where we see markets at the moment. Just to emphasise, shorting opportunities in this market are really quite plentiful and can provide good downside protection and a valuable source of alpha. I'll leave you with our performance as at the end of July, and we'll draw your attention to the 4 buckets, which is how we measure performance across the 3 shorting categories which we walked you through, in addition to the underlying core fund. I'm now going to pass you back to Mark, and thank you very much for your time.
Thanks, gentlemen. Always great to hear your views on the market, especially coming out of such an important time as reporting season. We have had a number of questions come in, so I might kick off with those guys. The first one is, from what I understand, many managers have found it difficult to outperform during reporting season. I note your performance slide is only till the end of July. How have you guys gone in the month of August from reporting season?
Yeah, that's a pretty good question. And as we sort of outlined, it has been volatile. It's been a pretty difficult reporting season. Touch wood, with 1 day to go, we're sort of pretty happy with our performance though. We've sort of made some good performance from some of those high conviction long ideas. Altium we walked you through earlier. We've also made good money from more of the outright shorts that we sort of mentioned as well. I think with 1 day to go, I think we're outperforming the benchmark by about 120 basis points, which in light of pretty difficult trading environment is sort of a good outcome, and we're sort of pretty pleased with that result.
Excellent, guys. Good to see the track record continuing, and it was a pretty tough month for many fund managers. I certainly know that. Another question's come in. Are there any market implications that you guys can see from a potential change in government going forward?
Sure. So, as Charles sort of lightly touched on before, I suppose, some of the most obvious implications would be around possible changes to negative gearing. So that could impact the banks and obviously some of those housing-related stocks. Then also, as Charles mentioned, any changes to dividend franking, so that could impact some of those high-yielding companies that are fully franked, or any companies that have high franking balances that could leave that stranded on their balance sheet, I suppose. Any caps on health insurance premiums as well, that obviously impact the health insurers. Again, any caps on utility prices would impact utility stocks. There's also been some chatter around restoring penalty rates, I suppose, as well, which would impact some of the consumer stocks or the retail names, I suppose. But I think really more than anything, a change in government will certainly create a lot of uncertainty in the outlook, which the market doesn't like. But what we know from history is that a bigger driver will be the improving underlying fundamentals of the market itself, which is sort of tempered a little bit by some really expensive valuations out there.
Okay. Another question, more comparing the Australian reporting season to the recent US reporting season. Is there any view on that, guys?
Yeah, I guess US is a bit of a contrast to us. They're sort of beating expectations over there. So I think 80% of companies beat expectations, and they're also reporting really strong earnings growth. So they're sort of reporting 25% earnings growth versus us, much more modest 5 to 7% earnings growth. So we would kill for that sort of growth over there. And I guess the other point, maybe for the bears out there, we're sort of in a bit of a holding pattern now until really November, as we hit into the midterm elections. So a bit of a news vacuum which sort of could see things sort of drift off a little bit.
Excellent. Okay. Question moving on to telecommunications sector. Probably one for you, Charles. What's your outlook for Telstra post the TPG Vodafone merger?
Yeah, very interesting development there this week with that announcement. And at Solaris, we spend a lot of time understanding industry structure, and more importantly, how changes in industry structure will affect the earnings within the sector. So what we think is that Vodafone will become a much more powerful number 3 player in the sector. The assets that are being combined, being TPG's large fibre network and Vodafone's mobile phone network, are actually very complementary. And so they will be a much more powerful and significant force than what they would have been separately. However, we do think it's probably positive near term. It takes a lot of the pressure off TPG were expected to launch their mobile network later this year, and we think that this could potentially delay the TPG launch, which takes a bit of pressure off the mobile industry at the moment. So you probably see a bit of a relief, but in the longer term, we still think, you know, Telstra will be significantly challenged as the incumbent from, you know, a strong Vodafone and stronger now Optus challenges. So we're still pretty cautious the sector, but we realise that this does change industry structure, you know, quite a bit. So we're watching it at the moment.
Excellent. Okay, another stock-specific question. Discuss WTC. We might explain the ticker code for WCT pre-earnings short. So discuss WTC short pre-earnings and how it affected the portfolio.
That's a good question. So WiseTech, along with a few other of the tech growth names, have been very topical this reporting season. So WiseTech reported their results and they gave financial year 19 revenue guidance that was above the street, predominantly due to a lot of their recent acquisitions that they've made. So they're making around 1 to 2 bolt-ons per month. So really it was a case of the sell-side community playing catch-up on a lot of the recent acquisitions in their modelling, which is where the revenue beat came from. However, because a lot of these acquisitions are lower margin bolt-ons, it had the effect of actually resulting in a net downgrade to their EBITDA guidance for 19. So you'd think that that sort of guidance would see the share price fall. However, quite the opposite happened, where there was a huge short squeeze on the stock, and I think WiseTech was up around 30% on the day of the result, and then squeezed further again on day 2 as the short scrambled to cover this trade. From our perspective, so WiseTech would be fit firmly in that outright camp where you need to keep your short trades short and swift, I suppose.
Yeah.
Given the monster re-rating in the stock just recently, we are now looking at it again from an outright short perspective because, again, it is trading on a nosebleed valuation. In terms of how it's impacted our portfolio, when we do short WiseTech, or if we were to short WiseTech, we wouldn't look at it on its own in isolation. We'd definitely pair it against some of the other preferred growth stocks that we like, such as Altium, to have a net positive effect on the portfolio.
Excellent, guys. More of a portfolio question in respect to capacity. A number of long-short funds have closed or are approaching capacity. How much are you guys going to run in this strategy?
Yeah, good question, Mark. We've sort of been purposely really conservative with our capacity. We've set it at $750 million firm, and as I said, that is struck off really conservative numbers. We want this product to always have a bit of an advantage on liquidity and size, and yeah, hence the firm commitment to not go beyond 750.
Yes, we want to remain very nimble in our ability to move around in our short positions. Very prudent.
I think the ultimate is ensuring that you guys can still deliver alpha. Look, that's all we've got time for today. We will wrap the presentation up. We will be making this webinar available on the Solaris Investment website. That should be available later today, which is www.solariswealth.com.au. We'd certainly like to thank you for your participation today. If you have any further inquiries, please do not hesitate to contact one of the Pinnacle distribution team or the Solaris website. Thank you for your time today. We certainly look forward to speaking with you on our next webinar or in person at one of our meetings with you or at one of our luncheons. Thank you very much and have a great day.